Welcome back to the channel. In our previous episode, we explored the foundational principles of the Boglehead's Guide to Investing, a book rooted in simplicity, discipline, and long-term thinking. If you haven't watched part 1 yet, I highly recommend starting there. The link is in the description below. Today, in part 2, we're getting practical. You're going to learn exactly how to build a Boglehead-style investment portfolio, step by step. This is not about gambling in the stock market, chasing trends, or trying to time the next big crash. This is about creating a long-term strategy that will allow your money to grow, quietly, consistently, and confidently, for decades to come. Let's begin. Brain, what is a Boglehead portfolio? A Boglehead portfolio is a simple, evidence-based investment strategy based on the teachings of John C. Bogle, the founder of Vanguard and pioneer of index investing. The goal is clear. Achieve market returns with minimal cost, low risk, and minimal stress. Instead of trying to beat the market, Bogleheads invest in the market itself, using diversified, low-cost index funds that mirror the entire stock and bond markets. This strategy doesn't require financial expertise, market predictions, or constant portfolio adjustments. It simply requires discipline and patience. Balance scale. Step 1. Determine your asset allocation. Your asset allocation is the single most important decision you'll make. It defines how much of your portfolio goes into stocks, for growth, and how much into bonds, for stability. A classic Boglehead rule of thumb is your age in bonds. For example, if you're 30 years old, 30% bonds, 70% stocks. If you're 50 years old, 50% bonds, 50% stocks. This strategy automatically becomes more conservative as you get older, reducing risk as you approach retirement. But this isn't a rigid rule. If you have a higher risk tolerance or plan to work longer, you might adjust accordingly. The key is to choose an allocation that you can emotionally stick with, even during volatile markets. Bar chart. Step 2. Use low-cost index funds. Now that you know your allocation, the next step is selecting your investment vehicles. Bogleheads keep it incredibly simple, and so should you. They often use just 3 index funds to cover the entire global market. 1. U.S. Total Stock Market Index Fund. This fund gives you broad exposure to the entire U.S. stock market, including large, mid, and small-cap companies. Examples: Vanguard VTSAX, Fidelity FSKAX, Schwab SWTSX. 2. Total International Stock Market Index Fund. This adds global diversification by investing in non-U.S. companies from Europe, Asia, and emerging markets. Examples: Vanguard VTIX, Fidelity FTIX, Schwab SWISX. 3. Total U.S. Bond Market Index Fund. This provides stability and income through a diversified mix of U.S. bonds. Examples: Vanguard VBTLX, Fidelity FXNAX, Schwab SWAGX. This approach is known as the 3-fund portfolio, and it's been tested across time, recessions, crashes, and bull markets. You don't need more than this. In fact, adding more funds often increases complexity without improving performance. Repeat button. Step 3. Rebalance annually. As markets fluctuate, your portfolio will drift from your target allocation. One fund may grow faster than the others, changing your risk profile. Bogleheads recommend rebalancing once a year to bring your portfolio back in line. Here's how. If your stocks have grown too much, sell some and buy bonds. If bonds have outperformed, shift some back into stocks. This process is simple and crucial. It forces you to buy low and sell high, without trying to predict anything. Moneybag. Step 4. Maximize tax-advantaged accounts. Before you invest in a taxable brokerage account, make sure you're using your tax-advantaged options. 401k. Especially if your employer offers a match, that's free money. Roth IRA or traditional IRA, for tax-free or tax-deferred growth. HSA. If you're eligible, this is the most tax-advantaged account available. Tax-advantaged accounts allow your investments to grow faster by deferring or avoiding taxes altogether. Man in lotus position. Step 5. Stay the course. This is the part most people get wrong. You can build the perfect portfolio, but if you panic during a market downturn, you lose the advantage. The Boglehead philosophy is simple. Ignore the noise. Trust the plan. Stay invested. You will face volatility. You will hear fear on the news. And your friends might brag about the next hot stock. But history is clear. Those who stay the course, who continue investing, rebalancing, and ignoring short-term hype, are the ones who retire wealthy. White heavy checkmark summary. Your Boglehead portfolio blueprint. Let's recap how to build a professional, long-term portfolio the Boglehead way. Choose your asset allocation based on age and risk tolerance. Invest in 3 total market index funds: U.S. stocks, international stocks, and bonds. Max out tax-advantaged accounts like 401(k), S, and IRAs. Rebalance once a year to stay on target. Stay disciplined, especially during market downturns. This strategy is simple. It's low cost. And it works. Direct hit what's coming in part 3. In our next episode, we'll break down the most common mistakes beginner investors make, and how the Bogleheads help you avoid every single one of them. From emotional decisions to hidden fees, these are the traps that derail portfolios. If you want to protect your wealth, don't miss it. If you found this video helpful, please like, subscribe, and share it with a friend who's ready to start investing wisely. Backhand index pointing down, let me know in the comments. Are you using index funds in your portfolio? Or just getting started? Thanks for watching. Remember, you don't need to be brilliant, just consistent. See you in part 3.